Okay, these are my notes from the 1999 Berkshire Hathaway meeting. Everything I learned, everything I thought was important and worth writing down. Warren said, "We don't think about the market. We look at individual businesses. So pay less attention to the market and focus on the business, not the market, not what the market's doing." He said, "We don't think of stocks as little items that wiggle around in the paper and have charts attached to them. We think of them as parts of businesses. When we can't find stocks we like at the price we like, the money piles up. When we can, we pile in. There should be no price you'd accept for risk if you're already rich. It's like saying no to any price to play Russian roulette. Whenever a really bright person goes broke that has a lot of money, it's because of leverage. It's almost impossible to go broke without borrowed money being in the equation." On what a really good business is, here's how he defines it. "We define really good businesses as businesses that earn high returns on capital, a 20% ROE, that's return on equity, at 5 times earnings, or a PE of 5. And you believe in the quality of the earnings, and they can reemploy a significant portion of those earnings additionally at the 20% rate. You will make a lot of money if you're right in your assessment on that," said Warren Buffett. "If we're right about the business, the macro factors aren't going to make any difference. But if we're wrong about the business, macro factors aren't going to bail us out. Generally speaking, trying to dance in and out of the companies you love on a long-term basis has not been a good idea for most investors," said Charlie, "and we're quite content to sit with our best holdings." So that goes against the idea of trading, swing trading, or short-term holds. "The hard part of the process of getting wealthy for most people is getting the first $100,000. If you have a standing start at zero, getting together $100,000 is a long struggle for most people. And the people who get there relatively quickly are helped if they're passionate about being rational, very eager, and opportunistic, and steadily underspend their income grossly." On insurance, he said, "If I didn't know anything about insurance and wanted to develop some expertise, I'd probably read the annual reports of every insurance company and just do a lot of reading." Warren said, "If we can just exercise or get rid of all the dumb things, it's just amazing what'll happen. To some extent, the record of Berkshire, to the extent it's been good, has been not because we've done brilliant things, but we've probably done fewer dumb things than most people. Why smart people do dumb things is the question." So he and Charlie over and over again keep talking more about what not to do and how it's more important than what to do. "Our game is to find a few intelligent things to do. It's not to stay up on every damn thing that's going on in the world," said Charlie Munger. When Charlie Munger was asked what books he recommends, he said he recommends 1, The Warren Buffett Portfolio, How the Investment Process Really Works by Hagstrom, 2, the book Titan, The Biography of John D. Rockefeller, and 3, Guns, Germs, and Steel, Revisited in The Wealth and Poverty of Nations by Landis. He said, "You're a better investor if you look at every one of the decisions you've made of importance and see which ones worked out and which ones didn't, and what is your batting average. If your batting average gets too bad, you better hand the decision-making over to someone else." "Magazines are better than books to learn investing," said Warren Buffett. Munger says, "I think both of us learn more from the great business magazines than we do anywhere else. It's such an easy shorthand way of getting a vast variety of business experience just to ripple through issue after issue, covering a great variety of businesses. You accumulate wisdom." "I don't think you can get to be a really good investor over a broad range without doing a massive amount of reading. I don't think there's any one book that will do it for you." So they recommend business magazines over books. "I'd guess that the CEOs of most public companies waste a third of their time at least in all kinds of things they do that really don't add a thing to the business. In many cases, subtract because they're trying to please various constituencies and waste their time with them that take the company backwards. Next is notes from the year 2000 Berkshire Hathaway meeting. A lot of people are asking about growth versus value stocks, or they think in terms of growth stocks versus value stocks. Warren says there is no distinction between growth and value. Charlie Munger said all intelligent investing is value investing. But if you stick with stocks that are not great businesses but undervalued, then you have to sell it when it reaches full value, which means you're moving around all the time. However, the investment where you find a few great companies and sit on your ass because you successfully predicted the future, that is what is nice to be good at. On PE ratios, what's a cutoff? Someone asked what the cutoff for a PE ratio is. What would be considered too high? Warren answered, there's no cutoff for a PE ratio that determines what they buy. But there is a focus on future cash flow for a 20-year period. Charlie Munger said, a business with something glorious underneath, disguised by terrible numbers that cause cutoff points in other people's minds, is ideal for us if we can figure it out. Next, we have a willful agnosticism on all kinds of things, and that makes us concentrate on certain other things. This is a very good way to think if you're as lazy as we are. When to sell. The first 20 years of his investing, he was short of cash, so he'd sell a stock that was selling at 3 times earnings to buy a stock selling for 2 times earnings. Now he has plenty of cash, but not enough ideas. That was Warren. We almost never sell a company, and when it does happen, it's because we've got some trouble we can't fix. On book value, or PB ratios, he said the really wonderful business requires no book value, and we want to buy businesses that will deliver more and more cash and not need to retain cash, which is what builds up book value over time. Book value outside of Berkshire, whose book value is determined by market value of its holdings, which is not a great way, but the best way, or a starting point way, to see Berkshire book value, is not a starting point of any kind in looking at other businesses like Coca-Cola. It's a factor we ignore. So book value is a factor we ignore. We do look at what the company is able to earn on invested assets and what it can earn on incremental invested assets. But the book value we do not give a thought to, said Warren Buffett. When asked about high valuations, he said, high valuations in one sector don't make the valuations in another sector look low just because the other is high. He also said the reason that they won't buy something, he said it's not that we don't understand the business or the product, but that we don't know where it'll be in 10 years. So even though they might understand the business, they don't understand where that business will be in the future. You can't avoid the wrong decisions, but if you recognize them promptly and do something about them, you can frequently turn the lemon into lemonade, said Charlie. Start out with good businesses and then keep adding on to the businesses, said Warren. Warren said, I can't imagine ever selling my shares and exchanging them for gold coins. I never understood what the value of gold was. I'd rather have productive businesses, said Warren Buffett. Charlie Munger said there are conditions where someone like a Jew in Vienna in 1939 might want gold. On whether EVA is more important than PE, PS, or PB. PE is price to earnings, PS price to sales, PB is price to book. Charlie says it's BS. We keep saying over and over again that the game is to turn the retained dollars into something more than dollars, and EVA tends to incorporate cost of capital ideas that just make no sense at all. It doesn't work. Charlie then said, we're perfectly willing to let something we don't understand very well rage on while a lot of other people make a lot of money that we don't, thus avoiding big falls.